All right. So, hope I find you well. I'd like to explain something which is quite interesting. I think I'll try and do that very fast. This is a paper that I have from October, November 2022 that I have here. And of much interest is the question that I have, which is number one of that paper, which is about Anika. Anika owns a property which she rents out to university students. She has made a consistent profit for each year she has been in business. Her trial balance as at 31 August 2022 was as follows. So if you're looking at this one, it's a service business. It's different from what we call a trading business. Remember, a trading business, that's one that we do the trading account. For a service business, it does not do buying and selling of goods. So it actually provides services. So the income statement is very simple for this one. It is just your income less your expenditure. Like in this case, they wanted us to do the income statement for this business. That's what they wanted us to do here. So how are we going to do it? First of all, you have to write your income there. You actually write, you have to write income there. Um, and you have to look for whatever different forms of income that we what that the business has, isn't it? So like in this case, this business income is basically we only have one type of income for this business, which is the rent receivable, isn't it? So this business income is rent what receivable. And if you're going to look at the rent receivable, I'm sure you'd see that the rent receivable is 162,000 uh, from this particular what business. Where are we getting that 162,000? We are getting it from here where it says rent receivable 162,000. But now the thing is, check, there is also an issue that we have, note number one, which says at 31 August 2022, rent received of 8,100 had been paid in advance, which means according to the matching principle, if you remember, prepaid rent is supposed to be deducted, but it's not for this year. It's not for this year. So which means that here our rent receivable is supposed to be 162,000, 162,000 less 8,100, less 8,100. Which one is this one now? This is the prepayment. Huh? That's the prepayment that we have here. Um, so it has to be deducted. So if you actually do that, I'm sure if you have your calculator close by, you should be able to calculate and see what do we get there. If you say 162,000 minus 8,100, so you get 153,900. 153,900. So you see, that's what you actually have to do. First of all, you have to make sure that you identify what forms of income do we have for this particular business, and then after that, we actually deduct all the expenses. So in this case, what I've simply done is I've deducted the prepayment because this rent was paid as 162,000, but there was a prepayment of how much? Of 8,100, which we must take because it's not for this year, it is for next year, according to the matching principle, if you remember. Then after that, what do we do next? We now say that particular amount less what? All expenses. Less all expenses. So we now have to look for our expenses now. We have to look for our expenses, all the various expenses that we have. So if you go up there, we can see that as part of our expenses, I'm sure we actually had what? We had general expenses here. You see general expenses of 26,500. 26,500. But we also have a note that says at 31 August, general expenses of 1,300 been paid in advance, which means that must be deducted from the 26 what? 500. You see, it's a prepayment as well. So our expenses are going to be what? General expenses. Okay. For the general expenses, we said that that's 12,000 what? 600 minus. Okay. We're supposed to subtract the prepayment that was made in advance. I think if you go back again, you see that our note says general expense of 1,300 had been paid in what? In advance. So we come down here again and we deduct 1,000 what? 300. Okay. So to be sure, our general expenses are how much? They are 12,600. Let's make sure about that. General expenses, they're 26,500. So 26,500 less what? Less the amount that has been prepaid. So here we say it is 26 uh, 500. 26,500. So 26,500 minus 1,300. What do we get? If you say 26,500 minus 1,300, we get 25,200. So we put it here, 25,200. Then we go back again and look for other expenses that we have. I think if we're going back here, we're going to see that as part of our expenses, we also have rates. Rates are 38,200. Rates 38,200. So we come down again and then we're going to say, we put our rates there. Rates, how much are they? 38,200. So you also have to look and check, are there somewhat adjustments pertaining to rates? Like in this case, if we go there, we can see that we are being told that according to adjustment number 2, um, we are told that and rates of 3,400 were owing. Remember, owings are basically accrued expenses. They should be added to our expenses. So which means here we are going to actually add the what? The 3,400 that was owing on our rates, because it's an accrued expense. Okay. So we're going to say plus what? 3,400. So we actually add that plus 3,400. So this is supposed to be an addition here, plus 3,400. So if we're going to add these, what do we get there? 38,200, 38,200 plus 3,400. So we have 41,600. Okay, so we actually added that accrued what? That accrued uh, rate. So we added it. So that adjustment is done. And then we go back and then we look again for another what? Another expense. So if you come down here, we're going to see that another expense that we have besides the rates is insurance. And insurance is 12,400. So we have to go back again and write insurance 12,000 what? 400. That's our insurance here. But we also have to check and see if we actually have any adjustments, which I'm also sure that we actually what have for insurance. Because if you look at adjustment, I think adjustment number 3, it gives us something to do with insurance, which says insurance includes 1,800 paid for 15 months period ending 30 November 2022. This is 15 months. For our year, we just need 12 months. So what we do first is we divide 1,800 by 15 months so that we see how much is being paid per month. Then I think if we do that, we're going to see that we're going to get 120 per month. So 3 months were prepaid, but we just need 12 months, which is 300 and what? And 60. If it's 120 per month, it means 360 was prepaid. So we actually have to go back again and then subtract the what? The 300 and what? The 360, like this. So we subtract it. If you say that 12,400 minus 360, it will give you 12,040. Okay, so that is how much goes to your income statement. So 12,040, and then we look again and check for other expenses besides insurance. I'm sure one thing we're going to see is that there is also repairs of 32,000. Repairs 32,000, and there's an adjustment as well that says, if you look at adjustment number 4, it says expenditure of 9,000 for new fittings has been recorded in repairs, which means that the amount which is in repairs, which is 32,000, includes 9,000 which is supposed to be taken off, which is not supposed to be in there, because this is regarding to capital expenditure and not repairs. So it means that from our repairs amount of 32,000, we also have to deduct the 9,000 there. So we're going to come down there and then say 32,000 minus what? 9,000. That is your what? Your repairs there. Your repairs is basically going to be 32,000, right, minus the 9,000 that was mistakenly recorded there, which is supposed to go to our fittings. So if you say 32,000 minus 9,000, if your calculations get you right, you see that you will get 23,000. So we're going to have 23,000 there. Um, is how much goes to our repairs. We don't need to forget the 9,000, because remember the 9,000 is regarding to capital expenditure, right? So don't forget it. It has to go to the fittings where it is supposed to what to go. We'll actually take note of that when we're going to be calculating depreciation, which is also an expense. Then we look again for another expenditure that we have there besides repairs. You see that now we come to depreciation. So depreciation, we have premises, and then we have fittings, isn't it? And if you look at our notes there, we are being told that depreciation is to be provided as follows: premises by equal installments on costs each year over a 50-year period. This means this one is going to be calculated using the straight line method, and fittings 20% per annum by the reducing balance what method. So this one is the reducing balance method. So what do we do here for the fittings? For the premises, premises are 418,000, and they are being actually what uh, depreciated using um, the straight line method, right, for a 50-year period. So what we simply do is we come down here and then we write our depreciation on non-current assets, isn't it? It's an expense. Depreciation, okay, depreciation. So here we have two things that are going to be depreciated. So we have premises. For premises, it's easy. We're simply going to say 418,000, I'm sure, um, divided by 50. Divided by what? Divided by 50. 50 what? 50 years. Well, they're saying that's going to be depreciated over a 50-year period on a straight line basis. So you're going to say 418,000 divided by 50. 418,000 divided by 50. It gives you 8,360. 8,360 is what is going to be charged as your what? As your depreciation for premises. And then we have fittings. Look at this one now. This is one thing that you may find um, if you don't become careful there, you get it wrong. Because if you check, remember with the 9,000 that we actually took from the repairs, right? If you look at this adjustment number 4, which says expenditure of 9,000 for new fittings has been recorded in repairs. So it means now we have removed it from the repairs and it's supposed to go to the what? To the fittings. And our fittings are 90,000. So which means 90,000 plus the the 9,000. So we have a total of 99,000, and the provision for depreciation is 71,000. So since we are using the reducing balance, we are now going to say for fittings, we're going to say 99,000 minus 71,000, right, which is our provision for depreciation. So 99,000 minus what? 71,000, like this, and then you say multiplied by what? That multiplied by 20% rate, isn't it? I'm sure this one you know that when you're calculating using the reducing balance method, you say in calculating depreciation using the reducing balance method, you say the cost minus the what, the provision for depreciation times the percentage. So you see that here is going to be what? If you say your calculator gets you right, you're going to say 99,000 minus 71,000, there you get 20,000, that times 0.2, which is 20%, so you get 5,000 what? 600. So if you check here, we have actually, I'm sure, taken care of every other what? Expense that is being incurred here. Remember what we did here was simple. We simply actually what? um we simply uh calculated, even identified how much was our income, and we saw that as part of our income, we only had one source of income, which was what? which was um, the rent received. And what did we do next? We actually found if there was an adjustment pertaining to the rent received, so that there was a prepayment of 8,100, and we deducted that, isn't it? And we saw that general expenses also, you had what? You had a prepayment that we also subtracted as well. And we saw that rates had an accrual that we added. Because remember, accrued expenses are added back, and prepayments are subtracted. So we catered for that one. And we also saw that for insurance, we had a prepayment for 3 months, which is 360, that we also subtracted. Repairs, we deducted the 9,000 that was put there, which was not supposed to be for repairs, which was for capital expenditure. We deducted that. We calculated the depreciation, and we did this. And then what do we need to do next? And take note of the layout. Take note of the layout is very, very important. We now add everything now. We now add everything now on the expenses that we have. So we're going to say 25,200 plus 41,600 plus 12,040 plus 23,000 plus 8,360 plus 5,600. So we get 115,800, and we put it here, 115 800. So remember, this one is going to be subtracted from our what? We're going to be subtracting it from our income of 153,900. So now if you say that one subtracted from 153,900, you get that we get our profit for the year of 38,100. 38,100 becomes our profit for the year. Okay, so that becomes our profit for the year. So that is how you do this one. I hope you have been assisted very well. Please take note of this on adjustments. Accruals are added. Accrued expenses, we add them, and prepaid expenses, we deduct them. It's very important for us to know that, to actually acknowledge the matching principle of accounting. Thank you very much for watching.